very important stuff. I mean, incredibly important. Um, the beauty of the signal is our ability to go everywhere, apply the signal to the instrument, get the correlations, understand the impact of the correlations, impact on the instruments on one another, and then it either confirms, increases the strength of the signal, or decreases. And I want to look at the long term, not the US yields, but European yields. And first, what do we know about them from the perspective of the signal itself and from the macro perspective and what's going on there? Unbelievably important. And timing is Jesus. The setup is getting more and more and more clearer by the day. Let's open up EU 10-year. EU 10-year. European bond yields. We will look at the signal on the 10-year in euro bond yields, and then we will transition into 30-year European bond yields. And 30-year is the yield we are interested in, because if we are talking about the TLT short, TLT as an ETF has a 2025, mostly 23, 25 year duration. So it's much more about the long-term bond yield than a 10-year bond yield. So it's that part of the curve, 25th, 25, and onward. So the EU 30-year is much more interesting for us in this regard, in comparing them to the TLT. If we are talking about the TLT short, and we are talking about the TLT short, the problem is we don't have an instrument to play the EU liquid instrument to play EU short EU bonds. So from the perspective of the macro, we know that Europeans are engaging, especially Germany and the biggest EU countries are engaging in a fiscal loosening and issuance of more and more debt, which in and of itself perpetuates higher bond yields. Pretty clear. The other thing is from the growth and inflation perspective. If you look at from the growth and inflation perspective from our favorite analytics, we look at the 42 macro models and Hedgeye models. Both of those things imply that the Europe and the biggest countries in Europe, such as France and Germany and Eurozone as a whole, is in a Quad 2 environment where growth and inflation is accelerating, which is indeed what is happening there. And it will continue to remain in Quad 2 environment throughout the 3Q25, and this is the timing that we need. Also, it will be in the Q4 of 25 as well. So, land of green here, land of Quad 2. Same thing here. Germany grid model suggests acceleration into July, October, January. Growth accelerating. Inflation is also going to be accelerating if you look at the 42 macro projections. And these guys is 80, 85, 90% correct on these models, on these growth and inflation models. France, stagnating growth but accelerating inflation. Eurozone as a whole, stagnating growth but accelerating inflation, which in and of itself, Quad 2, growth accelerating and inflation accelerating, speaks to the higher bond yields regardless, and Q3 also speaks to the higher bond yields regardless, on the back of high inflation and stagnating growth, but not as positive as Quad 2, where growth and inflation is accelerating at the same time, but nonetheless is the direction on a trending basis and trading basis within these regimes is to the upside for the bond yields, especially for the long end of the curve. So we know this. We know that the sentiment in and of itself is for more fiscal stimulus and higher bond yields in the European Union. We know this as well. So let's look at the history right now of what happened here. Let's look at the 10-year and overlay it with the US 10-year in and of itself. And first of all, these things are interchangeable. In the world of collateral, in the world of bonds, these are the alternatives, essentially. So if you don't want to buy the US bond, you buy EU bond. If you don't want to buy EU bond, you buy US bond. And this is why the correlation on a trending and trading and tail basis within these instruments are like upwards of 90-95%. It's palpable. It's obvious how insanely correlated they are. So that's pretty clear. If once again you look at the pinkish graph, it's the US 10-year, and look at the correlation on a daily basis, on a trading basis. It's spot on. If throughout this period, 1-to-1, literally 1-to-1 correlations on a trending basis, and on the trending inflections, it is 1-to-1 essentially. What we've seen happen over the last month, which was the unusual thing to happen in and of itself, but it did happen, is a divergence in between these time series. In what manner? What happened? First of all, the tariffs happened, and a massive outflows from the US happened. On this day, right here, the EU and Germany announced the new fiscal packages upwards of the Germany announced 500 billion, EU announced $800 billion. This is why the long end of the curve exploded higher, rightly so. Then it was overshadowed by the this normal retracement on the trading basis within a positive trend and tail impulse, normal retracement, overshadowed by going into April 2nd by the growth concerns and move in and of itself. This was just a normal retracement on the trading basis, normal, and then April 2nd came, and then a massive move lower in the bonds in and of itself, because what is the first reaction of the bond market to these news, to this growth negative news, this bombshell that was dropped on the economy in terms of US tariffs, right? So we're pricing in slower growth, recession, horrible, indices, equity indices are falling, credit is exploding, and obviously, technically, and first order reaction, bond yields are falling into that, and this is what we've seen right here in the US. Massive move lower. In the US, massive move lower. Then what happened? The US bond market blew up for the simple reason that there is no liquidity. Once again, the outflow has happened. The fiscal deficit that US is running is unsustainable. There is no one to finance it. And the biggest marginal financer of the US bond yields is the private sector and levered hedge funds. And they blew up because of the volatility, because of the VAR shock. VAR shock has happened and forced the hedge funds to close their position, to reduce the leverage and close your marginal positions. This is what happened. This is what we've seen. These blew up in US yields. Plus, the Europeans in and of itself selling, and the world was selling the US assets, because we've seen the massive outflow from the US bond market, from the US stock market, from the US currency overall. We've seen this because, and we've been saying this, that all money is here. US is the piggy bank for the world. As soon as any bad thing happens which is connected to the US, you break your piggy bank, you take your money, and you put it home. You go home. Japanese taking money home, Europeans taking money home, Chinese taking money home. This is what we've saying. This is what is currently happening. So the US bond market blew up, and instead of going higher, instead of the EU yields moving higher with the US on a trending basis, they went lower. It speaks for the inflow of the money into the EU bond market on the back of this blow up in the US bond market, and it's pretty visible in this correlation right here. So this has happened. This happened. What I'm speaking here for, and what I'm pointing out, that once again, the trending and tail direction of the travel for the EU bond market. Let's say we don't know anything about the US bond market, but we know that these things are correlated. And right now in this world, the US is not the price, is price taker. A US bond market doesn't set the price right now, because there are things like the EU bond yields and generally foreign bond yields, which are more attractive on the currency basis generally, because if you on a currency hedge basis, the US bond market is unattractive and the carry is unattractive. So in this world, where we've been in this world for the 30, 40, 50 years, US bond market was the price setter. It was setting the price for the global yields. Right now, the US is a price taker. So we need to look for what the other bond yields are doing, like the massive European bonds, and what they are doing, and what the EU bonds are signaling. On a tail, on a trend and trade basis, is upwards, as we've just talked about. Quad 2, growth, inflation higher, fiscal loosening, everything points to the higher bond yields, long and bond yield for the European bond yields. And the signal in itself, first of all, we've gone through the macro, just a little bit talk about theory, and let's look at the signal. Signal is clearly, this was your trend level, we never breached it, we never broke it, even on the 10-year, on the lower tenors. We are in a neutral trend in which, meaning we've just created a trend higher low compared to the previous one in the EU 10-year. If you look at the German 10-year, it's the same. If you look at the France 10-year, it's the same. If you look at we're going to look at the Great Britain 10-year as well, and Canadian 10-year as well. So the G7 10 years, we're going to go through them, and the signal out there is identical. It's the same. Signaling, massive move higher. Everything in here signaling a massive move higher. Like, listen to me, massive move higher on a trending and tail basis in a next 3, 4, 5, 6 months. Right now, so yeah, we did create a trending high low, so we are in a positive trend, a positive to neutral trend, because we need to break this trend lower high in here. Tail is positive, undeniably positive. Look at this. Tail is, we are nowhere near to breaking tail. We've just created trend high low with a positive tail momentum. And the trade is positive here as well. So the EU right now, EU bond yields are signaling move into 2.7 even on a short-term basis. EU 10-year is signaling move into 2.7. The higher the EU 10-year goes, the more upward pressure it puts on the US 10-year. And once again, after this small period of an unusual price behavior and breaking these correlations, we are going back to the normal order of business, where the correlation is as such on a trading and trending basis. All we need is another spark, and another spark in the US 10-year will be, once again, accelerating inflation, sticky accelerating inflation in Q3. We will go through this trough in inflation expectations over the next month, where the next inflation print will be lower in the US as well. But it's likely to be the last lower print in the US, bar if we get new developments and we go in immediately over the next 1-2 months, we go into recession and unemployment spikes massively, which is unlikely, highly unlikely, but it might happen. If that doesn't happen, then once again, an inflation outlook, it still persists, it's still the same. And this signal, once again, trending and tail signal in world bond yields and US 10-year in and of itself, and US 30 years signals the same. Higher low on trending basis and higher low on a tail basis speaks for a massive move higher in Q3, starting from the end of July, starting in August, into September and October. So 10-year, once again, the signal implies higher low on a trending basis moving to 2.7. This is a big move on a short-term basis. Speaks for higher US yields as well. And ultimately, from here, we should move, consolidate, and we should move higher into 3, 3.3, and beyond 3. This move, this impulse in the EU 10-year, this trending tail impulse, which is justifiable, which is supported by economy itself, by fundamental growth moves itself, is justifiable higher. We received this retracement on the back of a short-term dislocations in the market, and now we will be picking up, going 2.7, 2.9, and ultimately, in due time, we will move beyond 3% on the 10-year. But that's 10-year. Let's look at the 30-year, which, once again, we are much more interested in the 30-year bonds in 25-30 tenors than in 10-year. And let's look at them. Oh, let's look first at the Great Britain. Same thing, testing trend, high low on a trending basis right here. Still positive trend, positive tail, and positive negative trade though. Germany, same thing, positive tail, positive trade, positive trend. France, same thing. Canadian 10-year, same thing. we've been into the protracted consolidation throughout in all global bond yields. But the Carney policies, the new Prime Minister of Canada, speaks for more as well, more higher long-term yields. And once again, if we look at the projections right here in Canada, give me Chinese Canada Q2 and Q3 in the upcoming quarters right now speaks for higher bond yields. And Canadian bond yields will not stay in place when the global bond yields will move higher. In terms of the signal, once again, what is the signal saying here? This is your textbook creation of a tail high low. This is beautiful. If I didn't know anything about anything, and I was looking simply at the signal, I would be buying Canadian 10 years. I would be shorting Canadian bonds as well. What we did is naturally, after this massive protracted consolidation, we took out the tail low right here. We took it out. We broke the trend. And now we are essentially created a massive tail high low at 2.8. And we are positive on the trend and trade basis in Canadian 10-year. And in the short term, it's also signaling move higher from here into 3.5. This is what the Canadian 10-year is saying as well. This is the trade if I were trading 10-year. This is it. From here, in the next 3 to 5 months, it's signaling a move into a cyclical high in here, 4.2, 4.8, 5%. That's what the Canadian 10-year says. Now let's look at the EU 30-year. And the signal here is beautiful, is unbelievably clear. It is so clear. It's why I'm becoming, by the day, I want to short more and more TLT on the back of this. This is what we get. This is what we have. Look at the EU 10-year. And how compared to the 30-year, it's more neutral because, once again, as I've said, remember, the 10-year, EU 10-year is neutral on a trend basis, but positive on a tail basis. The EU 30-year is positive on the trend basis, undeniably positive on the trend basis, yet negative on the, positive on the tail basis as well. Look at this. This is a classic upward flowing market. This is positive on a trending tail flow momentum. This is beautiful. This is beautiful break, retest, retracement on a trend basis in here. We came in, tested the previous cycle high, and it speaks for the fact that we will break it and move into 4% and 4.5% on the 30-year. This year, not next, this year, starting in Q3 of this year. What we've just did this week, the previous week, what just happened is we've received the timely signal that this is it. The signal came in that this is the time to do this. It's not theoretical, it's time to do this. How that happened? Well, what we had here, once again, tariffs and everything else. We have trading lower high right here. This is your trading lower high in the 30-year. What we did here, instead of the EU 10-year, we broke this low on the EU 10-year. We broke it. That's why we created a trending lower high within that. But in the 30-year, look at this. We never did. We created trading high-low, took out the trade, moved into this trading high-low, took this out, and broke the trade resistance in here. This is it. This was the trade resistance, which we broke. This is it. And this is another trade resistance, which we broke again. So we created a trading high-low above the previous trading high-low. This is the trending high-low. This is your trend high-low, and this is your setup. This is your setup, which speaks for higher bond yields. This is it. This is your setup. This is your trend. You put the stop beyond the trend, and you move higher from here. And there is very little downside in the EU 30-year. That's why I'm saying that we are very close to the lows if we already haven't seen the lows in the US 30-year, in the TLT. This is it. I would be shorting US 30 year right here. Timing is beautiful. In the short term, we should be moving into 3.1% and then 3.2% and beyond that. This is your trending creation of a trending high low, and this is what you do. This is how you short this. The signal, by the way, is reminiscent of what the Bitcoin itself did. Look at this. This was your trade. This was your move in this trade. We took out this trade, created a trading lower high right here, this complex structure, and we broke it. On this day, we've said that the trend signal right here, for the Bitcoin has changed. What we did here is we ultimately moved lower, tested this once again, and created the tail higher low. Instead of the trending higher low on the Bitcoin, we created tail higher low. This is why we are so bullish on it. We were bullish since here, and now we are even more bullish. But the very cool, similar setup in here. But the EU 30 year screams higher from here. Screams higher. This is a massive signal, which is being supported by the macro itself and the signal itself, which is more important. This is why, if you look at the US 30 year, this is why I'm saying that we've already created tail higher low in the US 30 year. And from here, we should start moving higher and higher. We should accelerate starting from August. And this is how we are positioned. And this thing only implies that. What's the second order effects from here? Is we are positioned from this move in TLT and rates as a whole in the world, even though people are expecting recession right now in the world, and people expecting the yields to fall, counterintuitively they will start rising. This will weigh on the US assets. So in tandem, the EU 30 year and US 30 year should start moving higher. Oops. This is why we are saying that ultimately the next down leg into the US stocks will happen starting from August and going on into September, October. Driven mostly by this liquidity concerns, liquidity issues, driven in and of itself by rising long-term yields. The only other question, the second order effects, is we know what's going to happen with yields. Yeah, we know this first in this algorithm, first impulse is higher bond yields. It's just a question of how fast the policymakers will react and provide liquidity. They have to provide liquidity because if they let the market reprice the bond yields where the market wants them to be, it's going to be 6+%, 7+%. And it's going to be catastrophic. The US economy will not survive the 7+% on the 10 year, on the 30 year. Therefore, they will need to artificially suppress the yields. And as soon as they do, Dixie is going to die again. Dixie is going to this will happen again, and we might see Dixie be beyond 95 this year. The question is of timing. Will Dixie, with the rising bond yields, will the Dixie rise with the US long-term bond yields as it happened right here? Will the Dixie rise, or will the response will be more muted? Meaning, it's what's going to do is going to just create a retracement on a trading basis within a negative trend momentum and move lower. So essentially, will it do the same thing it did right here? This was essentially the massive recession pricing. This is the day the period when tariffs were announced. SPY was falling 10+% on the week. Credit markets blowing up, and usually how the dollar responds to this. Dollar responds to this like this. Dollar responds to this like this. Massive inflow in the US dollar. This time, with the massive, absolutely catastrophic moves in credit, in equities, this is what we've gotten. A trading retracement, meager trading retracement of 2% within a negative trend in which you should be selling this. And the question is, for me, is for us, and important question in terms of timing, will the, once again, as the long-term yields are rising? When will the dollar be reflecting these long-term yields and rising on a trending and breaking trend and moving higher with the bond yields? Or just the correlation will weaken even more, as we've seen right here, as we've already seen this fiscal crisis when yields are rising and dollar falling into this massively. We think this is going to happen. We think this correlation is going to break. This thing, the bond yields in the US will go much higher, and the dollar first initially will respond to this, albeit very unenthusiastically, and then ultimately when they come in, and then they use whatever ways they can to cap yields, the dollar will get smoked again, and we will see moves like this again in the dollar. This is our base case scenario, and this move in the dollar, if that indeed happens, this is not positive for the SPY. This will perpetuate the outflow from the US. This is why when they do come in with QE, with provision of liquidity, these US indices, the SPY, will be underperforming, as we are already seeing this. Everything else, it will be underperforming. Gold, especially gold, obviously, it will be underperforming continuously. Bitcoin, it will be underperforming European indices and Chinese indices as well. This is how US loses the capital war, and we've just seen the first inclination of this. This is our base case. The only question is of magnitude. When will they provide liquidity? When will they come? If they let yields go beyond 6%, then yes, obviously, SPY will go beyond 500, beyond 480. Easy. We will see retest and move much lower. It's in their interest to do this as fast as possible, because for the simple reason, the more they wait, the larger the liquidity provisions will have to be. So they can either devalue the dollar, provide liquidity, cap yields, I don't know, at the while the SPY is 540, or you can do this while the SPY is 400. And the difference in this is the amount of liquidity that you're going to provide, and it's much more reasonable to do this at 540. This is why it's either right now. I have no doubt that once again we are preparing for this by shorting TLT. We are waiting for this impulse, and the TLT trend and trade this position might not work to the extent that you want this to work, because for the simple reason, if they proactively provide liquidity and cap yields and do yield curve distortion, you will not see yields at 6%, even though they should be there. By all means, they should go there and beyond this. This is why we are very vigilant and looking at this timing. But the initial impulse, at least into 5.5, at least, should happen this year. Should happen in Q3. So this is why this is what we positioned for, essentially. And from here, we are waiting patiently, and we expect more strength in SPY to come, and ultimately somewhere in June, we will be positioning from here in this range, positioning short, targeting SPY at least 530 in the next move lower. And it's either going to be this, move into 530 and back again into the uptrend on the massive devaluation of the dollar, or it's going to be move into beyond this low. But I do believe this is unlikely. And when we move beyond this low, it is unlikely. It means the yields are spiking, destroying everything, and the Federal Reserve is doing nothing, which is highly unlikely. So the thrust of this video, and the unbelievably important in terms of direction and timing, is this. This is EU 30 year. This is monumental. This is the first domino that falls, that moves higher, speaks to the move higher in the US bond yields. And there we go. More conviction in our general outlook of where we go and why we're going there. That's it, I guess. This is all I wanted to discuss in here. Pretty much. Yes, on a short-term basis, it's pretty different in currency market, because currency market implies, if you look at the DXY itself, DXY is comprised mostly of euro and Japanese yen. Higher strength in the DXY on a short-term basis, especially going into Fed meeting, more strength in the DXY. But ultimately, we will create a trending lower high in here. What even more important is, it implies weakness for the DXY, for the dollar on a trending basis and tail basis, is this move. USD CNH breaking tail. If we do break this tail, if this move persists and we do close this weekly candle below this low, and we clearly break this tail, look at this. This is monumental. We and the world was expecting, as you see from here, massive this level, break of this level, and devalue the Chinese currency. It didn't happen. We are breaking in the opposite direction, and it is much more important. As important as if we were breaking in upwards. It means strengthening of the USD CNH. It means more weakness on a trending and tail basis for the dollar, massive weakness. It means, once again, more the fact that the US loses the capital war, the fact that the most likely the trade deals with China are coming due, and the first one to fold will be the US, most likely. Or if they don't fold, well, okay, they can go into, I don't know, recession. They can push themselves into the depression and then do something from there. Maybe start a war with Canada, China, or anybody else if they do want to push themselves that bad. Certainly, if you want to burn it, then you burn it to the ground and you start a war. And you, well, let's go. If that is that you want. Or they will be the first one to fold. Massive, unbelievably important signal in here, and this happens on the back of falling Chinese yields, falling long-term Chinese yields, which is negative for the currency, and the fact that they are doing more fiscal stimulus and providing liquidity as well, which is negative, should be negative for the currency, but as well as we see in this currently in real time, USD CNH breaking tail. Speaks for the fact, once again, in terms of the capital allocation, that FXI, things like this, on unhedged basis, you should be long the rest of the world, and you should be long China as well as Europe. China, as because you will get strengthening currency if the USD CNH breaking trade and tail, and you will get much more thriving capital market in here. So you will be winning in currency terms and in the equity terms as well. Completely the opposite, literally the opposite of what we've seen over the last 20 years. Literally the opposite. And that's that's it. That's monumental. This is this is incredibly important. So how we are positioned for this? We are understand that they ultimately, be it in late Q3, Q4 of this year, they will provide liquidity. This is what the Bitcoin is signaling by creating tail high low. And ultimately, we will go higher from here after the provisional liquidity. This is why we're positioned in a way that we are long Bitcoin, going our bet that we will see expansion starting from next year, starting from the late Q4 of this year, beginning of Q1 of next year. We will see provisional liquidity massive devalue of all currencies in the world and move higher. This is how we position in Bitcoin, and we're ready to weather and to sit through this move lower in when it comes, once again on the back of higher yields, or regardless recession pricing, anything like that. At the same time, we are ready to short Dixie when it comes, but right now what you should be doing is you should be preparing bond shorts in Europe and in the US as well. You should be short TLT, and you should be waiting patiently. And when the signal triggers, you should be shorting SPY going into the August and October. At the same time, shorting TLT going into August and October. And that's your general idea. And this setup works beautifully in two high probability scenarios. Either you get fall in US equities on the back of, as we've calling for, massively rising long-term yields, and both of your positions, and what we have on right now is put spreads for the October 17th on TLT. So your TLT position will work. And if you put a short on in and around 575, 580, 590 in SPY, your SPY position, your puts on SPY will work as well. However you're going to structure it, but the way you should be structuring it is somewhere, once again, same timing, September/October. And let's say we are wrong. Let's say bond yields are not going to rise because we are going into the deepest realms of recession. It's going to be catastrophic. Easy. And let's you say unemployment is going to be spiking over the next 3 months to 10%. Of course, okay, not a problem. It means that your SPY puts, which you put on from 580, 590 from here, will work beautifully, absolutely gorgeously from here. Your Bitcoin position will struggle but it's going to struggle regardless. It's going to struggle regardless because we expect it to struggle because we position ourselves with an idea that it's going to work. It's not going to work at all this year, only next year. And your TLT, let's say, and you say the TLT is going to rise and the yields will fall because everybody will flock into US government, US bonds. And as we've seen already, if you haven't noticed, in a deepest pricing of recession, as we've seen in April, bond yields will be falling to the point where they not, where they, in recession, US bond yields will spike, not fall. At some point, they will continue spiking and spiking faster until they provide liquidity. That's it. This is what happened literally this month, like 20 days ago. This is what happened. So this is how this is your win-win situation. And ultimately, you at some point, you want to be closing your SPY position in September, October, as soon as they provide liquidity. And you want to be closing your TLT position, pivoting, rotating, adding massively to Bitcoin, adding massively to European indices, Chinese indices, separate names that you like, maybe some names, separate names, but not the US indices as a whole, and short the dollar in the way of long in gold. Gold is a brilliant currency, and the correlation and trading trend basis is 1-to-1 to the dollar. And you can do this through euro, Japanese yen. You can do this through gold. That's the game plan as of now. And the massively important signal in the face of 30-year European bonds only confirm our understanding. Only confirm understanding and the timing of this move. So here we go. This is what we have on. This is how we're thinking is going to play out. And I cannot stress enough how important this thing is. How unbelievably important this thing is. And how closely correlated these things are. And how if this thing, once again, and this thing points to the fact that this thing literally screams, shit, this is long. Because this is creation of a trending higher low within the positive tail momentum. There is no better signal in the world if you're long something. Like this is what it is. So I guess this is it as of now.